first time ever.
Warning act of terror.
We are ready to engage with a two-state solution.
Some of his most senior cabinet members.
Advise us what our new economic is.
Today, we are looking at a major strategic shift in the global consumer market landscape. Starbucks has announced that it will sell majority control of its China operations to Boyu Capital in a transaction valued at 4 billion US dollars. But beyond the headline number, this deal reveals deeper trends about global brands. China's consumer market, competitive pressures, and strategic partnerships. Let's unpack what this move means, why it matters, and what to watch going forward. What the deal is. Starbucks, United States, Seattle-based premium global coffee chain, and Boyu Capital, a Chinese investment firm with consumer and retail credentials, will form a joint venture for Starbucks retail operations in China. Under the agreement, Boyu will hold up to 60% of the joint venture. Starbucks will retain 40% and continue to own and license the Starbucks brand and intellectual property. The business, being valued at $4 billion, refers to the cash-free, debt-free enterprise value of the joint venture stake. Starbucks estimates that its China business, say proceeds plus retained stake plus future licensing income, will be worth more than 13 billion US dollars. So Starbucks currently operates about 8,000 stores in China and aims to expand to over 20,000 stores under this new model. Regulatory approvals are expected. The deal is projected to close in the second quarter of Starbucks fiscal 2026. Why Starbucks is doing this? First, competitive pressure in China. China has become one of the Starbucks' most important international markets. However, local rivals such as Luckin Coffee and Coty Coffee have aggressively expanded, offering lower cost alternatives and capturing market share. Starbucks' market share in China has reported fallen from around 34% in 2019 to roughly 14% in 2024. Consumer behavior in China is shifting. More price sensitivity, local brands gaining loyalty, hybrid models, takeaway delivery are becoming dominant. Second, need for local scale and efficiency. Starbucks' traditional premium model, store premium environment crafted beverages, faces scalability issues in smaller Chinese cities and with more cost conscious consumers. Boyu brings local insight, capital supply chain, real estate network, and speed of execution, with Starbucks' need for next phase growth. Second, unlocking value while retaining brand control. Now, by selling majority control but retaining licensing and brand ownership, Starbucks keeps its premium global brand intact while delegating operational control to a local partner. So the US $13 billion valuation shows Starbucks sees long-term value beyond just the retail operations, branding, brand licensing, royalties, upside from growth. Then strategic pivot in market dynamics. China's consumer market is evolving rapidly, less about premium foreign brand novelty, more about local relevance, value experience. Global brands are increasingly partnering or even restructuring to keep relevance, local agility, and risk under control rather than just exporting existing models. Third, strategic implications. For Starbucks, if successful, Starbucks can scale faster, reduce cost burdens, benefit from Boyu's local partnership, and regain momentum in China. But it also shows Starbucks acknowledging that its old model is less effective in China without local adaptation and even partnership. So, what is the risk? Starbucks gives up operational control, more dependence on partner, brand consistency in China may face pressures, political regulatory risk remains in China. And what about for Boyu Capital in China market? Boyu gets a globally recognized brand and expansive retail platform. This enhances Boyu's consumer retail credentials. And for China, this reinforces the pattern of international brands forging strong local partnerships rather than operating solo. So, the retail market in China, especially smaller cities, value segments remain a major growth frontier. Starbucks aim to scale to 20,000 stores, which shows growth ambition. Then, for global consumer strategy and geopolitical business context, this deal is a clear example of global brands needing to cede more control to local partners to navigate China's evolving market environment. The ability of global firms to operate in China independently is becoming more challenging due to competition, regulation, local preferences, rising operating costs. From a geopolitical lens, China remains a critical market for global consumer goods. How foreign firms adapt their China strategy signals how China fits into global business models in the next decade. Then, for investors and global business watchers, the US $4 billion price tag reflects both opportunity and risk. Big market, but big challenge. Investors will monitor some stores' sales growth, expansion success in smaller cities, brand health, cost control, and impact of local competition. The structure may become a template for other global brands in China. Let's also see some key numbers. What was about the deal value? US $4 billion for majority stake in China retail operations. Starbucks retained 40%, Boyu holds 60%. Current China store count, if we check, 8,000 and the target is 20,000. So Starbucks China's business valued at less than 13 billion US dollars, where you include proceeds, retained stake, and future licensing. So Starbucks China market share dropped from 34% 2019 to 14% in 2024. Now, how quickly this joint venture expands into lower tier cities across China? Will Starbucks or Boyu execute store rollout speed, cost control, and localization? How Starbucks manages brand experience and premium identity is in a more valued oriented market. Will brand dilution occur? Some stores sales growth and margin recovery in China, these will show whether the restructure is working. Regulatory and geopolitical factors, China regulation, consumer sentiment toward foreign brands, supply chain logistics, and cost pressures. So whether other consumer brands follow similar models, this could signal a broader shift in global China market. So in simple words, if we see, Starbucks is recognizing that the China market of 2010s is no longer the same. Growth here requires agility, localization, deep local partnerships, and a different cost model. So the US $4 billion deal is more than a business transaction, it's a strategic adjustment. For businesses, investors, and strategy watchers, this move underscores a broader reality. Global brands must evolve their China approach, holding on to brand appeal while adapting to local realities, sharing ownership, and scaling smartly. So, in a global strategic context, this is a case study of how consumer brands navigate a once unchallenged foreign growth market. This is now crowded, competitive, localized, and even under cost pressure. That's all from my side. In this video, I'll see you in the next video. Jai Hind and Jai Bharat.